kind of controversial topic. You know, a lot of times the industry doesn't want anybody to think of insurance products being investments. And what most people don't realize is that back in the day, in the 30s and the 40s and the 50s, insurance companies were as big of an investment opportunity for consumers. They were bigger than securities, stocks, bonds, and mutual funds.
What's going on, guys? It's a Talk About It podcast. I'm Lauren Fulmer.
I'm Victor Dantas.
And he's just moving water here for Jason. Jason Dunn with us today. How are you doing?
I'm good. How are you guys today?
Good. Can't complain.
Thank you for coming, man.
Yeah, absolutely.
Yeah. Jason, why don't you go ahead and just give us a little intro. Tell us about yourself.
My name is Jason Dunn. I am the president and owner of iReview Corporation in Galesburg, Illinois. Do we want to talk about the co-working space too?
We can talk about whatever direction. Want. There's no script here, whatever. But just give us an intro about who are you.
In general, I'm an entrepreneur. I have a lot of ideas, and we like to implement those ideas in different business cases. I'm a problem solver by nature. So I see things that are ideas of having this problem in a situation where, let's talk about the insurance business. iReview Corporation is an insurance agency. It's an independent insurance agency that focuses on the review of life insurance and annuity products. We believe that there's a tremendous amount of consumers out there that have bought in the past life insurance products and annuity products, but have very little knowledge of those products. I think that a lot of people in the insurance industry focus on sales instead of focusing on being possibly like a life insurance agent. Life insurance agent, to me, is you're an agent for the customer. You have the knowledge base for that product or that industry, and the consumer's coming to you. Quite honestly, you know, a lot of people buy life insurance, but a lot of people don't know very much about life insurance. And annuities is, you know, a whole nother ball of wax. But let's talk about life insurance in general. I did not start out in the life insurance industry. I was in the military, got out of the military, went back to school, got a degree in computer science, worked in that realm for companies like AOL and Caterpillar in Peoria, Illinois. There's the most recent company I worked for. From 2000 to 2013, I worked for Caterpillar through another agency called Belcan Engineering. So the engineering background, basically what I'm trying to say is I have an engineering background and an engineering kind of mindset, the way I look at things. I see, being this problem solver or fixer, I see, you know, issues in the way things are done, and I'm always trying to think of how do we make that better, or what can we do to make that better, or how do we fix that, really. And a lot of what I find with insurance agents, consumers need a good insurance agent that have kind of a mindset of, they definitely need to understand the industry. How does the industry work? What kind of products they sell? How are those products going to help the consumer? But we take it a step further and want to literally mechanically understand how that product works. I find a lot of agents out there are salesmen. Most people, take a sales pitch from one of their companies. Maybe they're a captive agent. They work for, XYZ insurance company, and XYZ insurance company says, you're going to sell this product, and here's some, talking points. You're going to talk about when you sell that product. And you're really getting a lot of that fed from the insurance company. And my thinking is a little bit deeper than that. It's trying to understand, how do these products work? Where do I see problems in these products? What problems does the consumer need to understand before they buy insurance? My father had an insurance agency since 1984. He ran that in Knoxville, Illinois. And he was this, quintessential old school life insurance agent that everybody was his friend. They went to him because of the relationship they had with him, not because of the products he sold. They trusted him, those kind of things like that. And I've noticed since probably about the 90s, those kind of things, those small town insurance agents have kind of went away. They're more big box insurance agencies that, whether it's State Farm or a American Family, or they have what in the industry we call captive agents. So with this engineering mindset, one of the things that I noticed when I came to work with my father. So basically, why did I come to work with my father? Well, he was looking to sell his insurance agency and retire. And he couldn't find somebody that would really take care of his customers like he did. And he actually tried to sell it to a person in Galesburg, and that didn't work out. It ended up in a lawsuit, and he ended up getting that business back. And at the time, I was working at Caterpillar, and I was tired of the corporate atmosphere and a lot of things that go along, the frustrations that go along with that. Being an entrepreneur, you build and design and create certain types of things. And then when you're working for somebody like a big Caterpillar, it doesn't take long before you realize, hey, this is not mine. Okay. So I was kind of disgruntled with that whole career choice, not really fulfilling my entrepreneurship ideas. And when he was looking for somebody to run his business, I said, hey, why don't I run it for you and take it over and see how that works? And so we did that for a couple of years. And in doing that, I realized that a tremendous amount of his customers, really trusted him and really trusted the products that he sold them, but they also had a lot of older insurance products. And I'm mostly speaking about life insurance and annuities. They had a lot of older life insurance and annuity products that they had bought from other people, other agents, other salespeople. And that agent went away, just like as my father was going away. He was retiring, and in him retiring, he was going to be leaving those customers and not have anybody taking care of them. So it really came down to understanding what the customer's needs were. So for the first 2 years, I spent working with him in kind of a training atmosphere, on-the-job training. I realized that these people had products that they didn't have an agent for anymore. They didn't really understand how those products worked. And a lot of those products that they were buying for a specific reason wasn't fitting that specific reason anymore. Maybe they had gotten older and those needs had changed. Maybe their kids were grown up, stuff like that. But the point is, we realized that a tremendous amount of people had old life insurance policies that they didn't know anything about. And in the world of insurance, how do you make money? Well, you make money by taking premium from customer, giving it to an insurance company, you get paid a commission. How do you make a lot of money in insurance? You take a lot of premium from the customer and you give it to an insurance company and you get paid a big commission. And so from a business entrepreneur standpoint, I'm like, how do we make money in this business? And what's going to be our niche? What's going to be our difference between us and every other life insurance agency in town? Okay. Well, we decided that we really needed to focus on that consumer that had these old policies that weren't suitable to them anymore. So how do you understand if your policy is not suitable for you anymore? Well, you go to a insurance agent that you trust, and you get somewhat of a review over that policy. Typically, that review consists of understanding what the customer's current needs and objectives are, and making sure that product mechanically is going to do what they need to fulfill those needs and goals. So we believe that 90% of all life insurance policies out there that the consumer have do not truly fit their current needs and goals. So therefore, there's a lot of opportunity to help them fix that, and then help them fix that by giving them a product that does fit their needs and goals. Hence, now we're in the sales process to where we're taking their money now and putting it into a new product. When I said earlier, how do you make a lot of money in the insurance industry? You take a lot of money and give it to the insurance company. Well, a lot of the products that were sold in the 80s and the 90s were what we call cash valued life insurance products, whether it's whole life insurance or universal life insurance. And one of those types of products, universal life insurance, is a very controversial product that many consumers, while they're 20, 30, 40, 60 years old, don't have an issue with. But the universal life products have a lot to do with how they're funded, how you pay the premium. And a lot of times you'll see universal life insurance sold as flexible premium insurance or variable premium insurance, so you can adjust the premium. And essentially we were seeing by doing these reviews that a tremendous amount of people had these universal life policies that they're supposed to be a permanent policy. They're supposed to be for your whole life. And they were expiring at age 72, 74. And about the second or third time I sat in front of a little old lady and her husband and explained to them, just by reading their statement on their universal life policy, it says, if you continue your premium payments of $60 a month, your policy will lapse at age 75 years old. Well, clearly that was not the goal of those consumers, to buy a policy to lapse when they're just about ready to use it. So about the second or third time, I seen the customer physically crying because they were so upset because they had been paying on this policy for 40 years and it was going to be worthless in 2 months. I really said, let's focus on the review. This is a problem. This is a clear problem. So that's kind of why we started iReview Corporation. Again, my focus on that business is a fixing, a fixer role for the consumer. Develop a relationship. We have two concepts, basically, businesses relationships, number one, and number two, treat the customer like your grandma. And those are kind of, the second one, treat the customer like your grandma. That comes from, a lot of people in the industry use terms like suitability or best practice or best, customer interest, or let's throw another word out there called fiduciary. And to be a fiduciary means to always focus on making the best decision for the customer. So those are the two things we focus on, relationships and treating the customer like grandma. That really helps us make sure that we're doing the right thing for the customer. And the review of those policies. So essentially, we want consumers to become aware that just because they buy a life insurance policy and pay on it every month doesn't mean that life insurance policy is going to be there when they need it. They need to really kind of mechanically understand how it works from a consumer protection standpoint. And if it's not facilitating their needs, they need to understand that now and not after they've had it for 30 years. So that's kind of the gist of our business with the iReview. iReview, it stands for insurance review. It stands for investment review. But what it really means is I, the insurance agent, or I, the customer, take time to review these policies to make sure that what either the consumer has or what we're selling the consumer is the best product for them.
Yeah. What type of questions do you typically ask? When someone comes in, you talk about it, and most likely, if they bought something in the 80s or 90s, their life is definitely night and day different to, today. So when you, go through a customer needs assessment or some sort of breakdown, What are some of those questions people should be asking themselves?
Well, let's pretend you're here today to buy some life insurance, okay? And let's say maybe you have life insurance yourself. I'm assuming you probably do. Most people that have a family, they're buying life insurance probably to protect their kids if they die prematurely, making sure that the spouse has enough money to pay the mortgage, making sure, all of the income is going to be sufficient enough to continue the current lifestyle they have. So we want to understand, first of all, why are you buying this life insurance? Every customer is different. Young people are, I want to make sure that if I die, my spouse has enough money to send the kids to college or pay off the mortgage or, pay for all our bills and stuff like that, or supplement my income. Older people are not, they don't have those concerns usually. Hopefully they're out of debt so they don't need the cover the debt aspect. But majority of older people are saying, well, I need a final expense policy. I need a policy to pay for my funeral. Or I want to make sure little Johnny gets $100,000 when I die. And that's passing on a legacy. So we're trying to first understand why do you want to buy life insurance, or why did you buy this policy that you currently have? And so writing those things down, what their goals are, and then we take a look at how that policy works. There's hundreds and hundreds of different life insurance companies in the United States. Most have similar products, whether it's term insurance, whole life insurance, universal life insurance, variable life insurance, a myriad of products. But and typically most of those work the same way. I mean, similarly, each category of those. But we found some types of life insurance products like universal life that are A, very complicated for the customer, B, have a high potential of failure if they're not funded correctly, and we want to make sure that they're going to be there for the customer when they need it. So consumer understanding what that product's going to do for them and making sure it continues to fit their needs. That's really, it's not, there's not a tremendous amount it's not like a whole spreadsheet that we're filling out on, analysis of what the customer's needs are. It really comes down to be pretty simple. Why are you buying this?
Gotcha. Were you starting to say something before?
No, I was gonna ask him what's usually the most common goals and needs of customers when they buy life insurance. What do most people need and what most people want?
So for young people, and I say young people, I'm talking under 65 years old. I would say under 65 years old. Income protection. So I have a $120,000 a year job. If my spouse makes $80,000 a year, and if I die, my spouse is going to be short by $120,000 a year to get the job done, or maybe not $120,000 a year, but whatever part of my income is detrimental to paying the bills and paying what our goals are, college tuition and stuff like that. So number one, probably young people, replacement of income. Number two, I want to cover some debt. We got a big mortgage, or we had, $70,000 worth of credit card debt that we consolidated or something like that. If something happens to me, I want that to be paid off. Okay. I don't want my loved ones to be hindered by my debt. And then older people, like I said, final expense. So what is it going to cost to bury me? And then how do we get that set up? A lot of people think, there's a lot of advertising out there about buying prepaid funeral expenses, and nothing against funeral directors wanting to sell their product, but a lot of funeral directors are actually licensed as life insurance agents, and the way they typically do a prepaid funeral is you come in and say, hey, I want this funeral, here's the 10 things I want. The company says, okay, that's going to be $12,000. Here's a payment plan to buy that $12,000 plan. If you sign up for a payment plan, in 5 years or in 10 years, this will be paid for. You don't have to worry about it anymore. It's a prepaid funeral. What they really do is they take that money that they're paying and they buy a life insurance policy. The funeral directors or the insurance agent in that respect buys a life insurance policy. Maybe it's so they're paying in consumers paying in $12,000 for their final expense arrangement at the funeral home. The funeral home's taking a portion of that or all of that $12,000, buying maybe a $25,000 life insurance policy
on that person.
Yeah.
So how can they do that? I thought you have to have a vested interest in that person. To buy life insurance.
They're buying it in their name. The consumer is the owner of that policy.
Okay.
In their contract, the consumer does own that policy.
Okay, I got you.
And so but that policy is going straight to the funeral home. And so what I tell people, make your arrangements with the funeral home, get that set up, and then come to an agent and buy a guaranteed whole life policy that's going to be there for your whole life, no matter when you die, at 80 years old or 180 years old, doesn't matter. It's going to be there. And then assign that to the funeral home. And so, for instance, if you sign a $20,000 insurance policy to a funeral home and your bill is $10,000, the other $10,000 that you're not paying the bill with is going to your beneficiaries and stuff like that. Versus if the funeral home takes that policy out, all of that $20,000 is going to the funeral home. So little things like that.
Some of the example, like you gave an example of someone that, let's say the person dies and the person wants to make sure his wife will get $100,000, let's say. So if I buy life insurance today and I pay 1 month, 2 months or 3 months, and then I die in 4 months,
Yep.
will my wife get that?
Yeah, absolutely.
Even though I paid maybe $200?
If you pay the first premium and you die a week later, they're going to get paid that death benefit.
Okay.
But one of the things we're not talking about is the main two types of insurance, main two types of life insurance. One is term insurance and two is whole life insurance. Okay. Term insurance is what in the industry we call pure insurance. Okay. You're giving a premium to an insurance carrier that is basing that premium on your level of risk. Term insurance policies are for a term. They're only for a specific term, 10 years, 20 years, 30 years, set by the whole application process. You can buy a 10-year, a 20-year, a 30-year term. The 10-year term, after that 10 years, it's done. The insurance company is not anymore liable. So give me, in that same example, let's say you buy a 10-year term policy, you pay on it for 10 years, you were covered under that policy for 10 years. Even in year one or week one of the policy, you're covered for that $100,000 if it's in that 10-year term. But let's talk about the week after your 10-year term goes away. You're not covered by that policy at all. So,
Even though you paid for 10 years and
Yeah.
then you don't get that money back?
that's correct.
Okay.
It's
So
the same. You pay your car insurance for 6 months, 10 years, never have an accident, never have anything, but you paid it the entire time. Mm-hmm. You don't get any money back. You were just protected during that time.
if you would have died in that 10 years, you would have got paid. But since your term is up,
10
Then-
years, 1 day, you're
And
done.
nobody will want to die because you just...
Well, you would renew.
You
You,
just
would
died.
get another policy, or like he's saying with iReview,
Yeah.
is your 10 years has gone by. Your life situation may be different. Maybe you need more money now.
Yeah.
Maybe you need less money.
So how does it work to replace income then? Let's say the husband wants the wife to keep getting paid $100,000 a year.
yeah. So let's take that.
Does that make a lot of difference on the premium that they will pay every month?
Absolutely.
Okay.
So let's talk about one thing. One thing, all cost of insurance, okay? We have the premium that consumers pay for the insurance policy, and then we have another term called cost of insurance. Cost of insurance, most consumers don't realize this, but insurance companies actually buy insurance on those policies from a company called a reinsurer. Okay, there's a couple in the world. A big one is called Lloyd's of London. This is a huge insurance company. I mean, huge, millions of customers that are using Lloyd's of London. But the customers aren't people; they're insurance companies. So, insurance company wants to take out a policy on you. They say 10-year period. You're 35 years old, and they know between 35 and 45, your risk is very low. These are called actuarial tables. Okay, that's how they're figuring the cost of insurance, not the premium, the cost of insurance. So the cost of insurance is determined based on your risk. The insurance company assesses your risk, or the reinsurer assesses your risk, and says, for us to insure Victor for this 10-year period, it's going to cost this much money. Okay, that is the cost of insurance. It might not be the premium. The premium you pay is going to be the cost of insurance plus some profit for the insurance company. Okay, maybe let's say your premium per month is $10. Well, maybe $8 of those dollars go to the cost of insurance. The other $2 goes to, well, one goes to the company for profit, and maybe one goes to the insurance agent for a commission. Okay, so you're paying a premium. But the cost of insurance, as you get older, the reinsurance company is upping the cost of insurance because your risk is going up. Okay, so in year one of your 30, at you're 35 years old, the actual cost of insurance might be $6 instead of $8.
Is there an algorithm that calculates that?
I'm sorry, yeah. That is called actuarial tables. Okay. Actuarial science is essentially statistics.
Risk management.
Well, just look, as you get older, as you maybe get diagnosed with something, you know, everything changes. So the person, you know, I'm going to be more expensive to insure than you, just out of pure age.
Yep.
You know?
Yep.
And now if you have diabetes on top of it, you hear about these commercials out there. You know, come call us to buy insurance. You don't have to answer any medical questions, or call us to buy insurance even if you have diabetes or high blood pressure. We're going to guarantee you to still get that product. We can still get you that product. You know, you hear them on the radio all the time. Big Lou Insurance. You know, Big Lou's like you. He has diabetes too. So they're really focusing. That's term insurance. But my point to that is not the type of insurance, but the fact that there's this piece in insurance called cost of insurance. Okay, so cost of insurance drives the premium. It's going to drive the premium. The more risky you are, let's say you were a crop duster pilot. Okay, and pretty dangerous. Maybe crop dusters might not think that, but in the insurance industry, it's a higher risk. Maybe you parachute every weekend, or do something like, you know, skydive every other weekend. Maybe you fly hot air balloons. Okay, these kind of things. All of these things drive your risks up. Maybe you're a firefighter. Maybe you're a police officer. Those kind of things drive your risk up. So on a term policy, you know, some person working in a administrative office that's just typing at a computer every day is going to have a lot lower insurance costs than maybe a firefighter would, or a military person. And in fact, a lot of policies don't even cover military service. So the cost of insurance is a big deal, and as you get older, that cost goes up. Okay, so term insurance is for a very specific term in your life. And term insurance is affordable while you're young. You always hear people say, well, you got two types of insurance out there, term and whole life. Term is cheap, whole life's expensive. That's where the conversation stops. Well, that's not all the information. The information is why is the term insurance cheap? Well, typically people are buying term insurance, they're young. Their risk is low, so therefore the cost is low. But if you buy, let's say you buy a $100,000 term insurance policy and you're 45 years old, the premium for that might be $1,000 a year, okay? Maybe not even that. At 45, probably more like $400 a year, okay? Now let's take that same person, let's fast forward to age 75. You want to buy term insurance for $100,000 at age 75. That same premium is $12,000 that year, okay? The next year, it might be $12,500. At 80 years old, you know, I mean, it's going to continue to go up. So term insurance over 65 is just not affordable to consumers. It's not realistic. I got a lot of people that come in at 65 years old, they're retiring, and they're like, I want to get a life insurance policy. Why? Because I've realized my mortality is on the table here. I can see it in front of me. Okay, my parents are dead. My friends are dying. I want to get some life insurance to make sure my kids or my beneficiaries get a big chunk of money. It's not the time to buy life insurance. The time to buy life insurance is to plan it when you're young, so you're not going to pay as much over time. I mean, you're always going to pay the same amount of money, but whether you spread it out over time or you try to squeeze it in from ages 65 to 80, that gives you a shorter time period to pay on it. So therefore, you got to pay an exuberant amount of cost. So you got whole life insurance is a totally different animal. Okay, term insurance, you're buying pure insurance. That's all you're buying, essentially. And the commission that's going to the agent, and the commission, or basically the profit that's going to the insurance company. But it's pretty much cost of insurance. That's what I call pure insurance. Whole life insurance is a combination. So let's say a $100,000 policy. Now, instead of you paying $10 a month for that term policy, now you're paying $100 a month for that whole life policy. That $10 is still buying your cost of insurance, but the remaining amount of money is going into kind of a pseudo savings account for that whole life insurance policy. When you're young, that saving account is very low. So the company is buying $100,000 worth of permanent insurance for you, okay? They're essentially buying $100,000 of term insurance. But as you get older, a portion of that cash value is growing, and now let's say at age 30, you have $10,000 worth of cash value in that policy. the company only has to buy $90,000 worth of insurance to cover the death benefit of $100,000 because you have $10,000 cash value. Now let's move you to age 40. Let's say you have $20,000 worth of cash value. The insurance company has to buy 80, and your 20 plus the 80 equals your death benefit. Fast forward to you're 65 years old. Let's say you got $55,000 worth of or cash value in your policy. The insurance company's only buying $45,000 worth of insurance. So as you get older, it's buying less insurance, and your cost is staying level because you're not continuing to buy that $100,000 life insurance.
So the insurance companies have a bunch of money in their account because of those claims. Like they need to have, or the insurance companies have insurance as well. So if a client have a claim, a high claim, the insurance will be able to give money from somewhere to be able to cover that.
Yeah, they have both.
So they're under regulation and law. They have to have a certain amount of money on reserve. You know,
because,
just like the banks and everything else.
Yeah. Going back to my first example, if someone gets a 10-year,
term policy,
and you pay the first month, let's say $100, but then the person dies after 2 months. So now all of a sudden, the insurance company needed to give $100,000 to that client.
Mm-hmm.
So far, the insurance company lost
on that one person,
99,000.
but they just had 300 people pay them for 30 years and never collected a death benefit.
That goes to my next question.
Yeah.
So how do people start insurance companies? It must be very hard to start, because if you have 5 clients, one of them have a claim, the company is...
Yeah, you're not starting with 5 clients.
No? Okay.
You're going to have...
So there's no way to start from zero insurance company anymore.
I'm sure there is. It's just going to be more risk for you.
And a lot of money up front to
Right.
having the account in case something happens.
Insurance companies... There's it's kind of controversial topic. A lot of times the industry doesn't want anybody to think of insurance products being investments. Okay, it's always when you're getting your insurance license, you're not supposed to say this is an investment. Okay, but in reality, there's many ways to make money, and one is with banks, and maybe you go buy a CD with the bank, or you put money in a savings account and they pay you a certain amount of interest. That's one way to make money. It's guaranteed. A CD is guaranteed. The interest that's going into your savings account is guaranteed. It might just be 0.025% interest, but it is still guaranteed. The other way, so you got banks, you got securities, stocks, bonds, mutual funds, all kinds of products that are based on the stock market going up and down.
Yeah.
And then you got insurance products, insurance companies. And what most people don't realize is that back in the day, in the 30s and the 40s and the 50s, insurance companies were as big of an investment opportunity for consumers. They were bigger than securities, stocks, bonds, and mutual funds. Most normal people didn't have access to a stockbroker. Okay, it was only until the late 70s and the early 80s did we start getting, normal consumers start getting access to buying stocks and bonds, and then of course mutual funds and stuff like that. So it's always been, it's kind of a how do insurance companies make money by holding assets. So just as Lauren said, they're not paying your death benefit off of just your single premium. They're paying your death benefit what's called actually a risk pool. And the bigger that risk pool is, the more apt the insurance company is to not feel that pain of paying out that death claim. Okay? Law of large numbers. Okay, that's another term in the insurance industry. It has a lot to do with the more customers you have, the more ability to determine when and what is going to happen to that customer. So that's actuarial data. So the actuaries actually determine what the risk is for the consumer, and then the company prices that policy according to that risk. So it's pretty complicated, and it's not an exciting topic. Most people, I can tell you, before I even got in the insurance industry, I had life insurance. And when the statement would come, I'd sit there and look at the statement, and it was in a foreign language. I didn't understand it. I mean, not literally in a foreign language, but I didn't speak insurance. So I'd look at that policy statement, and it'd probably go in the trash, or it'd go in a filing cabinet, and I didn't know anything about it really. I just knew that if I paid my premium and I died during that term of that policy, my beneficiary is going to get paid. And that is 99% of all consumers out there. They have that limited scope of knowledge of how insurance policies work.
It's like with most things, people don't care until it's time to care, you know.
Yeah.
And that's just it. That's like, and not even just insurance or, you know, anything. You have spouses out here that, you know, well, she handles all the money. I don't have to.
Yeah.
I don't never mess with it. Well, and then something happens to her, and now he's like, you know, I used to work at the bank, and the people would come in. They said, "Lord, I don't know anything about money coming in or out of here. She did everything, and now all of a sudden it's a problem, right?" Never wanted to pay attention until now it's time to pay attention, and that's what you see. I mean, in so many different industries and everything, you know.
How do some people talk about, you know, investing in life insurance because you might have some tax benefits if you take that money out of there? How does that work? Investment for life insurance.
So, like I said, the industry doesn't want us to say that life insurance can be an investment, but in reality, can you make money with life insurance products? Absolutely.
How would that work?
So, one of the ways you can do that is by putting your money into a life insurance policy that pays a certain amount of interest each year. So we're talking about cash value life insurance. So as that savings account in that cash value policy builds up, the insurance company, per their contract, and this is another big thing that most people don't realize, all insurance, I don't care if it's car insurance, homeowners insurance, pet insurance, it's all a contract. It's a contract written by that insurance company and the consumer, guaranteed by contractual law in the state it was written in. Okay, so it's a contract. Versus if you go to the bank and they say, well, we're going to give you 2% interest on your savings account, there's no contract. There's nothing that you get in return that says they're going to do this. If they don't do this, I can take them to court. Okay, but in insurance policies, you could do that. Okay, so they're physical contracts. Each insurance policy is regulated by the state it was written in. So for instance, we sell insurance in 17 different states. We actually be physically licensed in 17 different states. And each one of those licenses, like our Colorado license, is administrated by the Colorado Department of Insurance. Okay, our Illinois license is regulated by the Illinois Department of Insurance. Most of those most of those states have the same rules, but there are some differences in different state rules. So it's a contract. That's a big thing to know. And in that contract, there's going to be certain specific things in there. What's going to be the premium I'm going to pay? How long is this policy going to last? Who is the owner? Who is the insured? Who are the beneficiaries? How will this policy paid out? Can I take money out of this policy if I want to? How do I pay it back? Is there interest that's paid on the cash value of this policy? And almost all life insurance policies that are whole life or universal life, they have a guaranteed interest rate in them. They have what's called a guaranteed interest rate that says for every dollar that you have in the cash value, annually we're going to pay you 2% interest or 3% interest or 4% interest. On the other part of that, I lost my train of thought there, but the interest in the contract is guaranteed. Okay. Now they also have the current interest rate. Okay. So based on whatever's going on in the world, bond prices are down, and so we're making a lot of interest on the money. So insurance companies take your money and they don't just put it in a box.
They will sell it too.
They actually take your money and they buy guaranteed investments with it. Okay, like bonds. Okay, large corporate bonds, large government bonds, stuff like that. Stuff that they know is guaranteed. That's the difference between a life insurance company and a bank and basically a stock or a stockbroker. Is insurance companies, like Lauren said, they have to have a reserve on the amount of, so for every dollar that they say they're going to promise to pay to their consumers, they have to have a certain amount of that reserved and backed in guaranteed investments. Insurance companies make money on holding assets. Okay, insurance companies don't make a lot of money on term insurance. They make a little bit of profit on a lot of people, but it's about volume. Whole life insurance products are really the cash cow for insurance companies because they can take those that dollars and invest it in guaranteed assets, and they might get 5-6%, or depending on what the current rate is for those kind of investments. So, did I answer your question on that one?
Yep. Yeah, because I always heard people saying to invest in life insurance, and I never understood really how. But yeah.
So the guarantees, you could say, I can take my money and go over here and put it in a CD, and the bank's going to pay me currently 5.1% on a CD. Okay. I can also take that same money and put it into an annuity. Okay, an insurance product. It's a product sold by an insurance company. I can put that same amount of money in an annuity, and they might give me 5.5% interest for a 5-year guaranteed period. The CD might be guaranteed for 13 months. The annuity might be guaranteed for 5 years. So there is a way to make money in there. And when we're talking guaranteed ways to make money, you basically have CDs and insurance. And there's not a lot of others that are contractually guaranteed to pay you, returns. Bonds, they can go up, they can go down. You can lose money on them. Stocks, bonds, mutual funds, we all know that. I mean, in 2008, 2009, people's 401k turned into a 201k, because the markets went down. Now, have they come up since then? Yeah, they have come up since then. And a lot of those people have made 20, 30, 40% since that time, and brought them, to a whole different situation. But we're talking about different types of products, guaranteed products with insurance companies. That's really going to be appealing to a certain group of people out there, people that are very conservative. I want to make money, but I don't want to lose any money, that kind of thought process. And typically you find that as the consumer gets older, okay? The consumer gets older, now they don't want to jeopardize, risk their money that they're trying to invest. They want more guaranteed investments. Okay. So when I said earlier, how do you make a lot of money in life insurance? You take a lot of money. Well, we typically work with people over 65 years old. Okay. Why do we work with people over 65? It was a choice of mine because I believe a lot of those people over 65 have a lot of these old broken products. That's number one. And number two, when you're talking about whole life products or universal life products, you're by helping them. So in that old product, let's say they have an old life insurance product, that a universal life policy that's going to expire when they're 82 years old, but they're 67 years old. Okay. Now they're not planning on dying at 82. They're planning on living longer than that. So they can see that I don't want this insurance policy anymore because I want it to go to age 99 or age 100 or something more realistic, because I want to live a long time. Whether they do or not, that's a different point. But so when they have a product that they feel that they don't want anymore because it's not going to last for their lifetime, we're talking it could have a considerable amount of cash value in that policy. So we take that cash value, we give it to insurance company, and we get paid a commission on that based on that amount of premium that we give to the insurance company. When you're talking younger people, we're talking lower cash value, essentially. And I'm not saying we don't want to mess around with younger people in low cash value, but when you're looking at what kind of business do we want to do, we'd like to do people, high cash value life insurance people, not necessarily whole life, not necessarily universal life, but some sort of business where we're holding assets or the company's holding assets or we're transferring assets.
Okay.
Makes sense. You mentioned earlier too, you got this community office.
Yeah, so our co-working space, space.
Co-working space. Sorry, I knew it was some sort of like.
It's kind of a new concept for smaller town places. Big cities, lots of big cities have co-working. Foreign countries, big cities in foreign countries also have co-working space. It's sharing office space is what you're doing. A lot of people maybe go work at a big corporation, and I can speak from experience because when I worked at Caterpillar, I worked in a building that probably had, 6,000-7,000 employees in it. And obviously Caterpillar rents that space or leases that space, or they own that space and all their employees work there. But COVID and other reasons have brought to people's attention remote working. Okay, and quite honestly, the younger generations have become a lot more, whether it's technology or whether it's advertising stuff, they're doing a lot of that stuff remotely, either working from home or working at their local Starbucks or at the library, if you will. Okay, maybe one day a week they go to the office.
Yep.
Maybe their office is in a completely different country. We have a gentleman in our co-working space that's actually from Spain. He actually works doing technology type stuff with a company in Central America somewhere. But anyway, my point is he doesn't work at the company. He works from home, or he works in this co-working space. So we didn't start the co-working space because I had this drive to have a co-working space. We started this co-working space because, quite honestly, we had a lot of extra space in our insurance agency. And I was looking for a way to get some sort of ancillary income on that space. And so in the world, there was these co-working spaces that I had seen, like in Chicago, Indianapolis, different places like that. A real famous one is called WeWork. A lot of people have heard of that.
Yep.
Okay, so essentially it goes from a leasing space for your office to having a membership to a space. And we provide, in our co-working space, we provide everything. We provide desks, we provide all the electricity, heating, cooling, internet, phone systems. And the reason I seen a need for this in Galsberry, because like this problem solving thought process that I have, when I started my insurance agency, when I incorporated it and moved it from my father's in-home office to our office at the Bondi building, I thought like the rent for the Bondi building was going to be like $400, $500 a month. I'm like, wow, that's easy. I could do that, piece of cake. Well, I did the rent, or I did the lease, and next thing you know, okay, I need the internet. Oh, now I need a phone system. Now, the Bondi building doesn't come with heat, it comes with heat, but it doesn't come with cooling. So now I need cooling. So by the time I got done adding all those things up, I was paying like $1,500 a month. Went from $400 to $1,500. As a business owner, as a startup, that was painful. So here I am. I got the insurance agency. We have extra space. How can I monetize some of that? Seen these co-working spaces, understood the pain of starting a business, and decided if we do this co-working space model, can we share the space that we do have, monetize that, essentially pay for some of our overhead? Wouldn't that be great? Not to mention, a lot of people don't like to work from home. Because why don't you like to work from home? Who doesn't like to work away from the office? Well, you get bored, you get lonely. There's things that distract you, okay? Things that you might have in a big office environment is a lot of collaboration between employees. Here I am working on this project, and I got some questions, or it's not really going well for me, but I take a break, I go to lunch, and I'm sitting there talking to my buddies that also work at the same place, and I'm sharing my frustrations or just talking about things, and I get ideas. So cross-pollination of businesses. The guy that is from Spain doing technology work, he's actually doing search engine optimization, SEO. And so he comes to work in our co-working space. Perfect example. He comes to work in a co-working space. iReview Corporation needs help on SEO. We seen that he was a really big player in that industry. He was a hard worker. Next thing you know, after many conversations with him, we approached him about doing our SEO for us. Okay. We've had psychologists and therapists up there that have a membership to IncuSpace. In conversations, kind of that water cooler conversation type conversation, we learned things from that therapist that might help our employees. And maybe we should have this kind of program or that kind of program to, for mental health and stuff like that. So the cross-pollination of a co-working space, to me, is limitless. And also, we're in Galesburg, and we're wanting to create this kind of entrepreneurship system to where people can come to us, or together we can make things a lot easier. And so there's a lot of new and growing business in these smaller farm communities in central Illinois. And as you guys well know, there's a big push to bring in entrepreneurs and new businesses and stuff like that. So we're trying to create at InQ Space, we're trying to create that kind of platform to where we can do some cross communication, understanding what other kind of businesses are out there. Maybe if Joe is starting up his business, but he's never done the incorporation paperwork, he may not understand how to do that, and I have done it, so I can help Joe do all the incorporation paperwork that he needs to, and kind of not have to go through all the painful processes that I had to do when I was learning how to do it and stuff like that. So
how many members can InQ Space handle, or what?
So InQ Space is, it's not our core business. I mean, we want it to be successful, but we want it to be functional. And one of the things with being functional is to have the right demographic of people in there. We've had a lot of people come in there and say, "Oh, I'd like to use InQ Space. I do nails. I want to do nails, so I want to bring I want to do nails in this co-working space." That doesn't really work for our atmosphere. So our co-working space could probably, depending on what the needs of the consumer would be, it could probably 15, 20 people on a daily basis could be utilizing that space. We've got 2,400 square feet. We've got conference rooms. We've got 3 private offices. We've got another probably 1,500 square foot area that is what we call the share space. That's kind of like the same type of space that you would get if you went to Starbucks. And, like you go walk into Starbucks, I'm going to work here for today. I'm going to, pick that seat over there, but I still got to deal with everybody else. That's the same with the share space.
Right.
So you might have 3 or 4 people sitting around you that don't do what you do. So we have private office space. It's one level of membership. A lot of people think we're doing leases or rent. They come to us and say, "How much is the rent?" There is no rent. Okay. It's just like, for instance, we use Planet Fitness as a good example. Okay. You buy a membership to Planet Fitness. You pay for a membership to Planet Fitness. You can use all their equipment when they're open. Okay. Same thing with our situation. You buy a membership you pay for a membership to InQ Space, and you can utilize our equipment. Printers, scanners, phones.
But not 24/7, right?
Not 24/7,
Right.
depending on what level of co-working membership you have. So we have 3. We have what's called a hot seat. That's like going into Starbucks and just grabbing a seat.
Okay.
If Susie's sitting there, you can't sit there.
Sure.
Okay. Then we have what's called dedicated desk. Dedicated desk that's your desk. It's always going to be your desk. Nobody's ever going to sit there except for you. You have it 365 days out of the year, whatever. Or not at 365, but we do have holidays. But my point is that's your desk. And then the third level is private office. So private office is, executive style desk, very nice, executive type chair, good quality furniture. We buy Han furniture because we think it's really great, and it comes from not too far from here in Muscatine, Iowa.
Yeah.
And highly quality equipment. Office furniture is super expensive. You can go to Office Depot and buy some crappy piece of furniture, but next thing you know, the wheels are broke, or the back on the chair just doesn't feel good anymore. It's worn out. It's cheap.
Kind of like our table.
Kind of like your table
And our chairs.
No.
But so in doing that, when we went to buy furniture, I think our first furniture purchase was 3 executive desks, 3 chairs, and like 4 small tables that we could move around and move into a conference table. It's like $16,000 just for that little bit of furniture. It's ridiculous. Okay. So that's another thing. Like, usually when you see a startup, you see this guy's got a little crappy office, his chair, his table, he's working from is either secondhand or really janky. And we're allowing you to utilize our stuff for small membership fee each month. And the nice thing about it is you don't have to sign a 6-month lease. You don't have to sign a year lease. you're signing a membership agreement that's month to month. If you started on the 12th of every month you're going to get billed just like you would Planet Fitness, and you're going to have access to it. If you decide I don't want to go there anymore, you quit paying it and you quit going.
There you go. That's cool.
That's cool.
Yeah, I've seen some people utilize that. Friends from Chicago come to town, stuff like that. So that's right, I've seen that. But
A majority of our customers are not from here.
Right.
Okay. We have a guy that came in yesterday. He's going to be here from Tuesday through Friday, and he's using a private office for those 4 days, and he's from, I think, Lincoln, Nebraska or somewhere like that. He's coming here because family. Somebody's in the hospital. He's going to help visit them and take care of family type of things. But while he's working, he works remote, and so he's working remote from our office this week.
well, I love that. I love that Galesburg's getting more and more of that. We've had the gal Chanel with Galesburg Tourism and things like that. But
Do you know Chanel? Yeah.
Yeah, we know
being
Chanel.
able to provide that for people traveling here, that's great and a really good idea. I'm glad that you brought that to the community as well.
Yeah, one of the things that I could tell, I would like to tell community people is this co-working space might be a different concept than you're used to, but you should really give it some consideration. It has the ability to drastically reduce your overhead costs and your startup costs to get started and doing things. And even people that have been established, we've had attorneys in there. We've had advertising people in there. We've had doctors in there. They're basically looking for a quiet place to work and somewhere that's nice and neat and clean. And so we focus a lot of energy on that. That space that we have for IncuSpace is very, I would say, new age looking, very
great. Yeah.
very clean. We also have like a kind of a kitchenette that we supply. Like, let's say Victor likes to drink San Pellegrino. We buy San Pellegrino for Victor to drink. Victor don't pay for that. He pays for his membership, okay? If Victor wants to drink 5 San Pellegrinos a day, we got him, okay? And next person, I like soda water, carbonated water. Certain people like different types of, drinks and stuff like that. We provide that stuff. We also provide stuff like ramen and little things that you can get, things that are cheap for us to buy, but it's nice for the customer that is in there and they don't want to run down and get lunch anywhere.
Yeah.
They just want something
A little
quick.
extra touch.
Yeah.
Well, Jason, I appreciate you coming and jumping on with us, talking a little bit insurance, as well as the IncuSpace, and hope you had a good time hanging out with us for a little bit.
Thank you guys for having me.
Thank you so much. It's Jason Dunn. It's the Talk About It podcast. I'm Lauren Fulmer.
I'm Victor Dantas.
And you guys have a great rest of your day. We'll see you next time. Thank you for watching this episode of the Talk About It podcast.
I'm Victor Dantas.
I'm Lauren Fulmer.
And we would encourage you guys to subscribe to the channel. And don't forget to hit the bell. It's going to be right below the video. So you
Hit
guys,
the bell.
so you know when the next episode is up. All
We
right?
appreciate all the support.
Thank you.